Right now, global financial markets are entering the second half of the day with a very different tone than earlier. Not louder, not more dramatic, but more revealing. The biggest movements in finance today are not happening through sharp price changes. They are happening through positioning. Markets are not asking what happened today. They are asking what happens next. This shift in thinking is critical, because when markets stop reacting to the past and start preparing for the future, behavior changes. Across global exchanges, activity continues, but conviction remains limited. Buyers are selective, sellers are patient. Liquidity is present, but cautious. This tells us something important. The market is not convinced that the current environment is stable, but it is also not convinced that a breakdown is coming. We are in a holding phase, and holding phases often decide the direction of the next major move. Interest rates remain the dominant force shaping today's second finance cycle. Even without new announcements, the reality of higher rates continues to influence decisions. Businesses calculate financing costs more carefully. Consumers reassess long-term commitments. Investors reprice risk quietly. Higher rates do not need daily headlines to have impact. Their pressure is constant. This is especially visible in credit-sensitive areas of the economy. Real estate activity remains uneven. Some markets show resilience. Others show hesitation. Transactions slow not because demand disappears, but because confidence has limits. Buyers want clarity. Sellers want certainty. Neither is fully available right now. Corporate behavior reflects the same mindset. Companies are releasing guidance that emphasizes caution. Words like measured, selective, and disciplined appear more often. These are not defensive words. They are adaptive words. Businesses are acknowledging that growth still exists, but it must be earned, not assumed. Banks reinforce this message. Credit flows continue, but conditions matter more. Balance sheets are under scrutiny. Cash flow matters more than projections. Risk assessment is stricter. This is not a sign of fear. It is a sign that memory has returned to the system. Financial systems remember stress for longer than people expect. The effects of recent inflation continue to shape behavior today. Even as inflation data stabilizes, spending patterns remain cautious. People do not forget price shocks easily. They change habits. They delay purchases. They prioritize essentials. This behavioral shift slows demand, and slower demand reshapes earnings expectations. Markets reflect this through rotation rather than collapse. Money moves from excitement to reliability, from high leverage to strong balance sheets, from narratives to fundamentals. This is a mature phase of the cycle. Not exciting, but necessary. Global political and economic signals add weight to today's second session. Trade discussions, energy supply concerns, and regional policy shifts quietly influence pricing. Currency markets respond faster than equities. Bond markets respond deeper than headlines. These markets often signal stress before stocks do. Today, they signal caution, not crisis. That distinction matters. It tells us the system is absorbing pressure, not rejecting it. Central banks remain in a delicate position. Their messaging continues to balance restraint with reassurance. They cannot declare victory over inflation too early. They cannot tighten aggressively without risk. This uncertainty keeps markets sensitive. Every data release feels important. Every comment is analyzed. But direction is still forming. This environment rewards patience. Short-term traders may feel frustrated. Long-term thinkers feel focused. History shows that some of the most important financial positioning happens during quiet sessions like this. Not during crashes. Not during rallies. But during hesitation. This is when capital moves quietly, preparing for scenarios rather than outcomes. The global economy is not signaling collapse. It is signaling adjustment. An economy driven by speed is learning discipline. An economy driven by leverage is learning restraint. These lessons take time, and while they are being learned, markets remain sensitive, controlled, and thoughtful. The mistake many people make during times like this is expecting drama, but financial reality often unfolds without spectacle. By the time clarity arrives, Prices have already moved. That is why awareness matters more than reaction. Understanding that silence can be informative. Understanding that stability can hide preparation. Understanding that the absence of panic does not mean the absence of change. Today's second finance story is not about what broke, it is about what is being rebuilt. Quietly, carefully, without attention. The global financial system is setting the stage for its next phase, and those watching closely can already see it forming. Not in headlines, but in behavior.